You've heard the basics of multifamily investing, but if you really want to succeed, you need to understand the bigger forces at play. In this video, I'm diving deep into the macroeconomic factors that drive Montreal's real estate market, breaking down cap rates like never before, and giving you the honest truth about financing multifamily properties in 2025. If you want to make smarter investments and avoid costly mistakes, stay with me. This is information every serious investor needs to know. Before we start, I want to give a big thank you to Club Atwater for hosting us today. Whether you're looking for fitness, squash, pickleball, badminton, or simply a vibrant social community in the heart of Montreal, Club Atwater is where it's at. Don't forget to consider them for your next big event. Check them out at clubatwater.ca. I've personally been a member here since 2022, and I absolutely love it. Feel free to catch me here about 3 to 4 times a week. Without further ado, let's dive into the macroeconomic factors driving Montreal's multifamily market. Hi, I'm Aguinaga with LG Realties in Montreal. If you caught my last video on multifamily investing, you already know the basics, why it makes sense, where to find properties, and how to manage them. But after posting that video, one of our amazing followers left a really smart comment. Hey LJ, you should expand more on the macroeconomic factors. They are the real drivers. Also, go deeper into cap rates. And by the way, 80% LTV financing isn't as realistic anymore. And you know what? They're absolutely right. So today, we're taking things to the next level. Let's start by looking at the big picture, how macroeconomic trends are impacting Montreal's real estate market in 2025, and what that means for you as an investor. The first thing smart investors understand is that real estate doesn't exist in a bubble. Your success, your cash flow, your appreciation, your ability to refinance or sell is directly impacted by what's happening in the broader economy. And right now, there are a few major macro factors you need to watch. First, interest rates. In 2025, we're dealing with ever so slightly higher than normal interest rates compared to the pre-pandemic years. What does this mean? It means your cost of borrowing is higher. Higher interest rates squeeze your cash flow, plain and simple. A property that might have cash flowed easily 3 years ago could now be break even or even negative unless you buy carefully. Second, inflation. Inflation is still playing a major role. Even if it's cooled off, here's the thing about inflation. It increases your expenses. Maintenance, repairs, labor costs, everything. But it also tends to push rentals higher over time because landlords adjust rents to keep up with rising costs. In Quebec, we have rent control, but in 2025, landlords were permitted a 5.9% rental increase, which is relatively high historically. That's one reason multifamily investing is still attractive. Even during inflationary periods, good rental properties are excellent hedges. Third, population growth. Montreal is still attracting both international immigrants and domestic movers from other parts of Quebec and Canada. People want to live here. More people means more renters, and more renters means higher demand for multifamily housing. Fourth, employment and wage growth. When wages are growing and employment is strong, tenants are able to pay higher rents. When employment weakens, rental markets soften. Right now, Montreal's employment base remains healthy, especially in tech, healthcare, education, and services, which supports stable rental demand. And finally, government policy. In Quebec, rent control limits how much landlords can raise rents year to year. You have to factor this into every investment decision. You can't just assume unlimited rental growth. Your returns have to work even with capped increases. So, what's the big picture? Interest rates are your headwind. Inflation and population growth are your tailwinds. And government regulation is your guardrail. All right, let's get into cap rates because if you don't understand them, you can't properly analyze a deal. What is a cap rate? Cap rate stands for capitalization rate. It's a formula that tells you how much return a property generates based only on the income it produces before considering any financing. The formula is simple. Cap rate is equal to net operating income, or NOI, divided by purchase price times 100. Net operating income is your gross rental income minus operating expenses, but not mortgage payments. Let's do a quick example. Suppose you buy a building for $1 million. And it generates $60,000 per year in net income after expenses. Your cap rate is 6%. $60,000 divided by $1 million times 100 is equal to 6%. Simple, right? But here's the important part. A higher cap rate usually signals higher risk. Maybe the area is rougher or the building needs major repairs. A lower cap rate signals lower risk. Prime locations, newer construction, higher demand, etc. Typical cap rates in Montreal right now for multifamily are around 4.25 to 5.5. If you find a building advertising a 7 or 8% cap rate in Montreal, look carefully. Ask yourself, is the neighborhood declining? Or are the rents above market? Are major repairs needed? Cap rates also fluctuate with interest rates. When rates are high, buyers demand higher cap rates to make the risk worth it. Always run your own numbers. Don't rely on the seller's cap rate sheet. Verify all expenses, taxes, insurance, maintenance, vacancy assumptions, because cap rates can make or break your investment. Now, let's talk about financing, because this is where a lot of investors get a wake-up call. In theory, you might think that you can get 80% loan to value, LTV, on a multifamily property. But in today's reality, it's much tougher. Here's what we're seeing on the ground. If you're getting a CMHC insured financing, you might still get close to 80% LTV, but it comes with higher insurance premiums and stricter underwriting. For conventional commercial multifamily financing, think 5+ units, most banks are offering 65 to 75% LTV. The bank looks not just at you, but more importantly at the property's performance. Does the income cover the debt service? Is the building in good condition? Is the rental market strong in that area? Do you have experience doing this? Plus, with interest rates higher, the debt service ratios are tighter, meaning banks are way more cautious. What does this mean for you? Well, first off, you'll likely need to bring more capital upfront, maybe 25 to 35% down. Second, your property needs real, verifiable cash flow to qualify easily. Third, you must have a realistic business plan and strong financials. The good news? Banks are still lending. Multifamily properties are still a favorite asset class, but you have to be prepared and work with experienced brokers and advisors who understand these nuances. The MLI Select program is an amazing program that has made purchasing multifamily investments a lot more accessible. I have a few clients that bought buildings with as little as 5% down. I'll do a whole video dedicated to that program soon. This program is absolutely amazing, and I hope they don't change it anytime soon. So there you have it, the real story behind investing in Montreal's multifamily market in 2025. If you want to succeed, you need to understand the big picture economy, master financial metrics like cap rates, and plan realistically for today's financing environment. If you do that, you'll be way ahead of the competition, and you'll be on your way to building serious long-term wealth. What's your biggest concern about investing in multifamily properties right now? Let's talk about it. Need help finding or analyzing a great deal? I specialize in multifamily investments, and I'd love to guide you. Book a consultation through the link in the description, and don't forget, like, subscribe, and hit that bell so you never miss an insider update on Montreal real estate investing. Thank you so much for watching. I look forward to catching you on the next one.